Good afternoon and welcome to BizTech's Asian Midday Market Watch, powered by the Private Pension Administrator of Malaysia, or PPA, which is the central administrator for private retirement schemes. It's Tuesday, the 28th of March, and we have, as always, Charu Chanana, market strategist from Saxo Markets. Charu, great to have you on the show.
Hi, Brian. Such a pleasure for me as well.
Now, Charu, before we get your insights, we're going to take a look at how markets across the region are performing in the first half of the day. We'll also start, however, with crypto markets. We've got Bitcoin, which is at 26,897. It's down 3.64%. Ethereum is at 1,712. It's down 0.3%. Now, looking across the regional stock markets, we've got the Straits Times Index over at your end, Charu. It's up 0.39%. Bursa Malaysia on the KLCI is up 0.34%. Shanghai is up 0.05%. The ASX All Ordinaries is up 0.94%. The Nikkei is down 0.02%. The Hang Seng is up 0.52%. And rounding up the numbers, we've got the Kospi, which is up 0.64%. Now, Charu, what's your view on market performance in the first half of the day?
Yeah, Brian, nice to see those greens there on your screen today. And of course, it is, I think, a signal that we got from the overnight markets where there was a sense of calm prevailing in the markets after, we didn't see any further stress in the banking sector. And, I think the pressure that was there at the end of last week on Deutsche Bank, on First Republic Bank as well, all of those kind of came off a little bit. So I think that calm is obviously going through in the Asian markets as well today.
Now, and we have had, as you said, calm returning to the banking sector, but have we really averted a crisis?
That's really the big question we should be answering, right? I mean, we did not have any further bank failures over the last 2 days, which is obviously good news. But the stress is certainly there. I think the market is very nervous at this point. Today, later on, when the Western markets open, we have US and UK parliamentary hearings on the collapse of the Silicon Valley Bank. I think that will expose again the fact that markets are extremely nervous. But at this point, I think the markets have also accounted in for too many rate cuts from the Fed. So there is some room for that, to reverse as well, because inflation is still a problem. We do get some key inflation metrics out this week from the US, which is the PCE. Also in Europe, we get the flash March CPI numbers. So, I think the markets are a little bit nervous about that too, because, can we really get as many rate cuts as the market is priced in if the banking situation remains under control?
Okay, one sector that has done well out of this crisis is actually the tech sector. So we've had a real run up of tech shares as people move away from the banking sector. Why has this happened, and what's your take on this moving forward?
I think, the tech sector, the mega caps, they've actually served as a little bit of a safe haven during this banking turmoil. Some of the reasons why that has happened is because, of course, we've seen a big collapse in yields, right? The treasury yields in the US have come down massively. And these big tech companies, these tech players, which have a lot of cash flow in the future, they are extremely yield sensitive. So when your discount rate is going down, of course, your valuation appears to be a little bit more attractive. So that's one reason. But secondly, also, I think this is a time when investors are becoming extremely conscious about, companies that are heavily dependent on credit financing. Like you said previously, we may have averted a crisis, but there is obviously a fear in the markets now that we will have a credit crunch, which could potentially bring forward the next recession. And that does mean that those companies which rely heavily on financing will be the first ones ones to get hit there. Whereas these big tech companies, they are cash rich. Their balance sheets are relatively strong. They have a lot of margin, scope as well. They have a lot of price action ability. So I think that's making them a little bit of a safe haven right now. But like I said, they're not recession proof per se. So we have to be really, be cautious about that as well.
Now, Charu, then, given all this uncertainty around markets, as investors, how do we de-risk our portfolios?
Yeah, I think that's really the most important thing to do right now, Brian. I mean, even if things look better because yields are going down and you're starting to price in Fed rate cuts, eventually that means that equity risk premiums will go up and the markets will have to price in a recession, and that will mean that there could be more pressure on equity. So I think it is a very good chance to look at your portfolios and make sure you first thing, don't have excessive exposures to those small cap stocks, which will disproportionately be hit during this recession, I guess. And also obviously have some downside protection, whether it is puts or have some exposure to fixed income, which are relatively more stable. Have some safe havens in your portfolio. For example, gold has been doing quite well, but there's obviously a lot of further scope for gains in gold still. The Japanese yen as well, that's a big safe haven. So I think it's important to consider having some exposure to these.
Now, Charu, as always, thank you very much for your insights. Thanks for coming on the show.
Thank you, Brian.
Now, I'm Brian Fernandez, and we've been speaking to Charu Chanana, the market strategist from Saxo Markets, on BizTech's Asian Midday Market Watch, powered by the Private Pension Administrator Malaysia (PPA), which is the central administrator for private retirement schemes. This video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. It'll also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.